When it comes to investing, there's lots that can go wrong. What if you spent hours researching a company just to find out it's going downhill and see your investment crawl to zero? Or you might miss out on a potential gem that could climb to the moon and see you make a massive return. Being able to pick out the right business to invest into and making sure that you don't get burned along the way when you're trying to find a gem can be a difficult process, and there's lots of other mistakes that are a part of the investing world. Throughout the course of this video, I'll be showing you some easy to follow strategies that don't require any special skills or prior knowledge to implement, and these are some of the things that I wish I knew earlier when I first started on my investing journey. Some of them are hard to learn without first-hand experience, so if you want to learn from the mistakes that I have made, make sure to stay tuned throughout the course of this video. The first thing to keep in mind with investing is that you don't want to be doing it based on emotion. You don't want to buy into a company just because the stock price is rising, and you don't want to sell just because you see the share price falling in value. There's more to it than that, and if you're just in it for the short term and you want to ride a wave, of course you can make some money on that. Just look at meme stocks like GameStop and AMC, or some coins in the cryptocurrency space like Dogecoin that have seen massive returns in a very short space of time, and there's definitely people that have made a huge profit from these, but overall it's definitely a risky way to go. You don't know at which point you're buying into. You might be nice and early buying right at the bottom, you might be in the middle, again being able to ride that wave to the top, or you might have bought at the peak when the price was at its highest value, and then you're left holding the bag when everybody else sells off for their profits. Most likely, if you follow this type of investing, greed will get the better of you, and you'll keep on trying to push the boat out. You'll keep on trying to hold on to that investment to see how high it can go, and then ultimately a massive drop in share price will be the thing that makes you sell off your investment. The goal with investing isn't just to find the newest and most impressive company that you think will make you the most money. It's all about the long term and having proper research and understanding of where your money goes. If you're just following a trend, it can work most definitely. I've invested in some meme stocks and made quite a good return, but it's not something that you want your whole investment portfolio to consist of. Seasoned investors like Warren Buffett, who have a net worth of over $100 billion, strongly preach a buy and hold strategy for the majority of investors. Putting your money into a nice diversified ETF like the S&P 500 is one of the most tried and true investing strategies. Sticking with this, especially in the beginning when you first start out, is a great way to make sure that you don't fall into the trap of investing based on emotion, and it will help you avoid a lot of the other mistakes that I'll be covering in this video. Number 2 is thinking that you have to be the best stock picker to be a good investor. A lot of people have the misconception that investing takes a lot of time, energy, and effort. Of course it can do this, but it depends on the type of investing that you want to do. As I said earlier in the video, one of the best strategies is looking at ETFs like the S&P 500 to consistently put a amount of money in week by week, month by month. As an example, you might be able to put in $50 a week into this investment, and you just want to be adding that routine amount every single week, year after year, so you can build up a portfolio that will track the average return of the overall stock market. The S&P 500 is deemed to be an accurate representation of the overall stock market performance because of the types of companies that it is made up of. These include businesses like Tesla, Facebook, and Amazon, large established companies that have stood the test of time. And this strategy doesn't require any prior knowledge or research. All the companies in the S&P 500 are put in there based on their market cap, based on the size of the business. There's no one picking and choosing which companies are going to be placed into it, and therefore you can have a very set and forget strategy. Of course, you can spend hours researching a business if you would like to, but that's only reserved for investing into an individual company. If you put your money into ETFs, then your investment will be spread out amongst all the businesses that make up that particular ETF. The S&P 500 isn't the only one. You also have the ARK Innovation ETF if you'd like to put your money into more speculative growth companies like Square, Tesla, or Roku. So there's a lot of options in terms of ETFs that you can look at, and they are a great way to avoid the time commitment that a lot of people associate with investing. And they also stop you from having to try and time the market. There's a saying that goes, time in the market is better than timing the market. So if you can stay in the market for as long as possible, you let your money grow and compound over time and gain interest on itself, instead of trying to worry about the daily or weekly ups and downs that naturally occur in the stock market. If you only focus on these short-term changes, investing can be a very stressful and time time-consuming experience. Number 3 is not looking at the fees associated with a brokerage platform. When anybody uses a broker, there's always a fee associated with things like buying and selling shares, exchanging from one currency into another. There might be a fee for topping up your account with a credit card as opposed to a bank transfer, and you have to keep all of these in mind to calculate how much money you're actually spending. For example, in New Zealand, the brokerage fee for Sharesies is based on a percentage of your investment, and you are rewarded for investing more money because the more money that you invest, the lower the brokerage fee will become. So as a rule of thumb with Sharesies, any investment up to $3,000 will be charged a 0.5% fee, in comparison to another broker like Hatch, where there is a flat fee of $3 per investment. And then finally, you can also have brokers where there is a zero brokerage fee, so there's no charge for buying or selling shares. Platforms such as Stake or Robinhood boast this zero brokerage fee, but something to keep in mind, if you're looking at Stake, there's a 1% fee for your foreign exchange on your currency. So if you're an Australian trying to invest in the American market using Stake, you're going to have to pay a 1% fee to convert your Australian dollar into a US dollar. So on paper, Stake might look better because their brokerage fees are zero, but then their foreign exchange fee is a fair bit higher, in fact over double that of Hatch. So you have to keep in mind what you're being charged for, because more often than not, you're not going to get a completely free experience when you're using a broker. Of course, the broker has to make money for itself as well. There's something that has to fund the platform, and there has to be a way for it to get money from its users to remain viable. Of course, there's nothing bad about that, but it's just something that you have to keep in mind and not get lured in by the fact that they might boast zero brokerage fees. Instead, you have to look at what other factors that you're being charged for, because at the end of the day, everybody has to make money, and a platform isn't going to run without having any source of income for it. Number 4 is never getting into investing because of misconceptions. When it comes to investing, a lot of people deem it to be a complicated, risky, or time-consuming activity, or they might believe it's just something that's exclusive to people with a lot of money or that have a background in finance. Most people are aware of investing and know that it's a way to make more money, and they never really look into it properly and don't get started with it in the first place. And due to these misconceptions, a lot of people never get into it and lose out on a lot of the rewards and opportunities that it can make for you. But talking to, say, friends or family might put them off. And the perspective that people have on the stock market really does vary depending on their age. Often people in their 40s or older might not be very keen on the idea of the stock market, as they've experienced a lot of stock market crashes and financial recessions, especially the one in 2008. And anyone who was an adult at that time that had a house or a business or was working full-time in their career and suffered financially from these sort of stock market crashes is not going to think that investing is a very viable option. Or if someone has followed hype or purchased into a meme coin and didn't buy in at the right time and lost a portion or a majority of their investment, this small experience might scar them and change their perspective of investing, make them think that it's just a risky idea or that it's almost the same as just gambling with your money. It's always easy to focus on the negatives, and it's almost human nature for people to do this. But if you look into investing and take the time to actually understand it and think about the opportunities that it can make for you, it's most definitely worth your while getting started on your investing journey and actually doing some research into it before making the assumption that it's something negative. Number 5 is just listening to people on social media without doing any of your own research. You might watch a YouTube channel or look at an Instagram page of someone talking about an up-and-coming company that has a massive price potential, and just from this one piece of content, it might be a video or a post, they will put all of their spare money into this investment without properly looking into it or even checking out another video or another content creator that's talking about the same investment, so they can have two different ideas on the topic. It's really important to understand where your money is going, because with any investment there's always going to be ups and downs along the way. No stock market or even cryptocurrency investment is going to have a consistent increase with no dips along the way, and you're just investing purely based on another person's opinion, then you're not going to have the confidence to hold onto that investment when it sees drops in the share share price. Often these normal price fluctuations can scare people into selling, but that's only because they don't know if they're justifiable. Is there a fundamental change in the business that's causing this drop in share price, and is actually a reason to sell it, or is it just a part of the normal stock price movements that happen with any investment? A great way to get more understanding on a company is again to look at more content creators that might be covering the topic, so you get multiple perspectives on the same thing. Listening to interviews from the management so you can see how the business is running, see what the future plans are for it, and to see how good the management team actually is in looking after that company. You can also read large financial documents called 10K reports that are written by the company. 10K reports are easy to find. For example, if you wanted to find the one for Facebook, all you type into Google is Facebook 10K report, and this will give you all of the 10K reports for Facebook. And these reports give you all the information that you need about a business. It'll talk about the management's up and coming plans, any risks to their cash flow, how the business makes money, any problems that the company has faced, and their future plans for resolving it. So looking at all these factors, you can really make a confident decision on where that business is going and how profitable it will be for you. If you want a complete guide on how to get started with stock market investing, from which broker to choose, how to actually buy and sell companies, and some ways to research a company before you invest into it, then check out this video on screen, which will cover all of those details.